got a big week for macroeconomic news ahead of us. In the UK, the biggest number to watch is the GfK consumer confidence figure that's due on Thursday the 31st of May. The April reading was a rather turgid -9, down 2 points, while the major purchase index, do consumers plan a big item of spending, well, at least that rose 1 point to +3, but even that was down year on year. It will be interesting to see if confidence starts to pick up now that wage growth has started to exceed inflation again, albeit only just. If so, that could be good news for retailers, travel and leisure stocks, and also, wait for it, possibly the house builders. The experiences of the last 10 years at least suggest that consumer confidence has an influence on mortgage approvals. We're also due the latest Bank of England mortgage approval numbers on the same day, the 31st of May. Last month's reading was just over 62,900, and mortgage approvals can in turn affect house prices simply through the mechanics of supply and demand. We've also already had one house builder, Crest Nicholson, suggest that house prices may be peaking, so let's see how the consumer confidence numbers look. Meanwhile, stateside, we get the latest non-farm payrolls and wage growth numbers from America Friday the 1st of June. If these start to run hot, then the US Federal Reserve is more likely to press ahead with its plan for 2 to 3 more interest rate increases in 2018. That's from the current level of 1.75%. Any more those 2 or 3 increases would take the total to 8 or 9 for this upcycle, and as regular viewers know, that's the average number of increases it's taken over the 8 tightening phases since 1970 to stop the US stock market in its tracks. For the record, America added 164,000 jobs in April, against a 12-month average of 176,000, and that took unemployment down to just 3.9%, but wage growth was still modest at 2.6% year on year. This next chart shows the trend in monthly job additions and wage growth. Company-wise, it's a bit quieter here in the UK. We have annual general meetings at fund manager Standard Life Aberdeen on Tuesday the 29th, Silvermine Fresnillo and Royal Bank of Scotland on Wednesday the 30th, and a trading statement from FTSE 250 retailer Card Factory on Thursday the 31st of May. But for me, the stock most likely to cause a big fuss in the week ahead is Johnson Matthey, when the FTSE 100 member reports full year numbers on Thursday the 31st of May. As we can see here, shares in Johnson Matthey are on a good run. They're up by around 15% over the last year, and that compares to a 5% gain in the FTSE 100 over the same period. And that's also enough to put Johnson Matthey at not just a new 12-month peak, but pretty much an all-time high for good measure. Johnson Matthey will be seen as a potential beneficiary of the pound's spring slide that was caused by the Bank of England's latest flip-flop on interest rate policy. The firm generates around 1/3 of its sales in America, 1/5 in Asia, and nearly 2/5 from Europe, albeit including the UK. So those overseas profits will be worth more when they're translated back into sterling. When looking at the figures, management has given guidance on 3 numbers in particular. Sales, where the forecast was for a 5% increase in constant currency terms. In the first half, sales were up 6% on a constant currency basis and 15% on a reported basis. For the full year, analysts are looking for a reported headline number of £15 billion against £12 billion a year ago. The second figure to watch, well, that's restructuring charges. Management has guided to £50 to £60 million worth of them, which will depress the headline pre-tax profit number, where the analyst consensus is for £455 million against £462 million a year ago, including those supposedly exceptional costs. And that comes before a rebound to £507 million in the year just begun. And the third figure, that's capital investment. Guidance is for £285 million. Besides those, key themes to watch are how demand for catalytic converters is holding up in light of the turn in sentiment against diesel cars. Emission control systems make up around 60% of Johnson Matthey Group sales. Secondly, watch for further signs of progress at the health operation, which makes ingredients for pharmaceuticals. And also watch for commentary on the fledgling electric battery business. The crux here is that Johnson Matthey's enhanced lithium nickel oxide, or ELNO, cathode material for electric vehicle batteries uses a lot less cobalt than current technology. The final key figure to watch is the dividend. At the interim stage, management hiked the distribution by 6%, and for the full year, analysts are looking for a 4% increase to 78.2 pence a share. That equates to a dividend yield of around 2.2%. Now, some of you might not be that impressed, but such an increase would keep Johnson Matthey in the elite club of 26 FTSE 100 firms that's grown its dividend every year for the last decade. And according to figures from Thomson Reuters data stream, Johnson Matthey's dividend growth streak actually dates back to 1987, which is some record indeed. This final graphic shows the dividend progression for the past decade, with consensus forecasts going forward for good measure. Thank you for watching, and I look forward to seeing you next time.